Great. Good afternoon, everyone. We'll let people sign in. Thank you for joining us this morning, or I'm sorry, this afternoon. I hope everyone had a great Patriots Day and Marathon Monday if you're joining us from Massachusetts. We have a really exciting program today. It's a little bit different than what we normally do. We usually are gearing these programs towards adults across Massachusetts, but we got a lot of requests for a teen program. And so here we are during April vacation in Massachusetts hosting this event. So to get started, I will go through just a quick introduction remarks and talk a little bit about who we are at the Office of Economic Empowerment, as well as sharing some disclosures. And then we will go through some housekeeping. I'll give a quick shout out and a thank you to our partners for today's event. And then we will turn into the actual program, which is on Introduction to Investing for Teens. We will hear from two participants from Invest in Girls, Grace Chen and Emily Kai. And then they will turn it over to Andrew Menfee to go through an Investing 101 presentation as well as Q&A. And then we'll have closing remarks and Q&A from Margot Mattes from Brookline High School. So quickly, the Office of Economic Empowerment is an office of the Treasurer and Receiver General of Massachusetts, and we do a lot of programming on closing the racial and gender wage gap, helping families save for their child's futures, and financial education. We'll put our link to our website and some of our other resources in the chat today, so you can learn more about who we are there. And hopefully you will tune into some of our other programs that we have going on this month. This is a Zoom webinar and will be recorded and will be uploaded onto a public website for future use. Any information shared through the chat, through the question functions will be anonymous, but please note, however, that the chat record is subject to public record laws and as such is not anonymous. It's a webinar and not a meeting, and as such, you will not be able to view the other participants, but you can use the chat feature to communicate to the host and panelists, and Q&A will be available throughout the webinar. And finally, we hope that you'll complete the post survey so we can continue to improve our programs here at OEE. I want to give a big thank you to the Massachusetts Board of Library Commissioners. Throughout the month of April, the Office of Economic Empowerment is partnering with the Massachusetts Board of Library Commissioners and libraries across the state to offer financial education programs and resources for library patrons, as well as all residents of Massachusetts as we celebrate Financial Literacy Month. Visit your local library to learn more about the different resources we have available, including bookmarks and coloring sheets and some of the other tools that we provide for Massachusetts residents. I also want to thank our presenters today and our partners at the Council for Economic Education and Invest in Girls. So without further ado, I will turn it over to Emily and Grace and take the program from there. Thank you so much.
Hi, my name is Emily.
I'm sorry, I would turn it over to Abby Cox and she will introduce that.
I'm sure Emily and Grace are going to do an amazing job. I'm just going to briefly explain who the Council and Invest in Girls are. So the Council for Economic Education and Invest in Girls believe that every student should get a strong financial literacy education. CEE supports economics and personal finance teachers and sponsors the National Economic Challenge and the National Personal Finance Challenge, where students can demonstrate their mastery of these topics. Invest in Girls is a program for young women in high school to learn the basics of personal money management and investment, to explore different kinds of careers in finance, and to meet women professionals in the field. We operate in many schools across Massachusetts, and we're really pleased to have 3 of our Massachusetts Invest in Girls students with us today. Emily Kai and Grace Chen of Acton-Boxborough High School, and Margot Mattes of Brookline High School. And I'll hand it to Emily and Grace to talk about their experience with Invest in Girls and to introduce our speaker. And Margot will help moderate the Q&A and wrap up the program. So take it away, Emily and Grace.
Hi, I'm Emily. I'm a senior at Acton Boxborough Regional High School in Acton, Massachusetts, and I'm so excited to be at Money Talk Tuesday. Through Invest in Girls, I participated in a mentorship program called Exploring Finance, as well as a fellowship at Brown Advisory, both of which I learned a lot about personal finance, sustainability, and heard a lot about the various career paths offered in the industry. And most importantly, I felt really empowered and supported by women. And then this fall, actually, with the help of Abby and Grace, who's also here, and I were able to bring Invest in Girls to our school in the form of a club where we do weekly financial literacy workshops and have guest speakers in the industry come to talk to us about their experiences and their careers. And that's been really eye-opening. So needless to say, Invest in Girls has been a really great program and a really great experience, and it really helped spark my interest in finance, which is something I now hope to pursue in college and in the future. Yeah.
Hi everyone, I'm Grace. I'm also a senior at Acton Boxborough Regional High School, and similar to Emily, I've participated in the Exploring Finance and the mentorship programs at Invest in Girls. And although I'm not 100% sure if I want to go into finance or not yet, Invest in Girls has informed me about like a variety of different skills regarding finance that will be relevant in the near future, regardless of whether I go into finance or not, such as managing taxes and savings and investing. And I thought this was just really eye-opening because I guess like most schools don't offer something like a financial literacy class. So I thought Invest in Girls would just be a good program to join just to learn about those life skills that we kind of need. So now I'm going to be introducing our next speaker, Andrew Menfi, who will be giving us an introduction to investing. Mr. Menfi received his Bachelor's of Arts in Social Studies at Binghamton University and his Master's of Arts in Secondary Social Studies Education at Columbia Teacher College. He has spent the entirety of his career teaching social studies in New York City and currently teaches at New Vision's Charter High School for Advanced Math and Science in the Bronx. He has taught economics, government, legal studies, global studies, independent research, and advanced placement, US history, and is the current lead of the independent senior project team at his school. Take it away, Mr. Menfi.
Thank you so much, Grace, and thank you so much, everybody, for being here. I'm going to jump straight in because, I mean, the fact that a lot of you guys are here on what I'm assuming is your spring break tells me that I don't want to take any more of your time that we've already taken. So thank you again for being here. So today we're going to learn very basically an introduction to investing. Investing, come on, what could not be great about that? It's all about making more money. Everyone wants to make more money. So let's jump straight into it. I want to make this as interactive as possible because as much as I love hearing the sound of my own voice drone on for an hour, I'm not sure if you guys love hearing it as well. So I'm going to start by asking a question, and I want you guys to use the chat if you got that chat function open. So let's get just a very basic one to get a baseline out there. When you hear the term investing or investments, what do you think of? What words do you think of? What things do you think of? And just throw it in the chat, just make sure you can find it, and let me see what we can find. Stocks. Yes, I'm so happy they came up twice. Thank you so much, guys. What else we got? We can get at least another one or two more words in there. Risky. Real estate. Ooh, of course. Don't put a question mark there, Matthew. Of course, you're correct. That works. There's no wrong answers here. IRAs / retirement accounts. Oh, wow. You're bringing in IRAs into this mix. Now you're getting fancy. I love it. All right. Perfect. So, stock exchange, connecting the stocks. Excellent. Happy you brought that up as well. I'm going to jump. Oh, we got one more from Jacob. Putting money towards companies or a project. Yes, excellent. That fits as well. Now, I want to start with a couple of those that I just noticed. The ones that I want to start with is stocks. And once again, I could thank two of my lovely students here that were kind enough to not only make that the first word, but to put that at the same time. Often when people think of investing or investments, the first thing they think of is stocks, which is reasonable. It's probably the most famous type of investment, but it's not the only type of investment. Real estate is another very famous type of investment. Generally, this idea of putting money towards a company, as Jacob brought up, is a type of investment
think we lost Andrew for a moment. Hopefully he'll reload and come back. Andrew, we
Can you hear
lost
me
you for a
now?
moment, but you're back now.
There we
Thank
go.
you.
Can everyone hear me?
We can hear you, yes.
Beautiful. Let me jump straight back into that. My apologies. What was the last thing I said out of curiosity before I cut out?
I think you were saying something about putting money into a company.
Thank you very much. So many people think of investments, something like stocks or putting money into a company or real estate, and all those things certainly are investments. But there are other things that are investments that you're probably familiar with that you probably wouldn't think are investments. Similarly, there are probably some things that you are not familiar with, which are excellent ways that you can invest your money, get that money to grow. And that's what we want to talk about today. What I really want to talk about today is some of the more basic types of investments that maybe someone like you guys could do. Someone who's maybe 16, 17, 18, maybe about to graduate high school, going to college. I don't want to be teaching you necessarily anything that you can't do in the immediate future. I want to teach you something that you could potentially use right now or within the next year or two. So let's jump straight into this. I'm also very happy that someone brought up the term risk in the chat, because that's a term that's going to come up a lot today. Generally, when you are looking at investments, any way to take a certain amount of money and make that money grow, there are three things that you are looking for in terms of having a quality investment. Number one, obviously, you want an investment that gets you the highest possible return. And when I say the word return, that of course refers to an increase in the value of the money you put in. I put in $1, it turns into $2. I put in $5, it turns into $15. Obviously, you want the best investments that give you the most bang for your buck. Obviously, there's a little bit more to it than that. The ones that generally get you the most bang for your buck have a catch when it comes to it, which brings us to my second bullet point there, risk. Every single investment has a risk associated with it. When you are taking your resources and you are giving that set of resources to an outside entity, you always cannot be 100% sure that they're going to take that money and cause it to increase. You can never be sure. So there's always some risk involved in investment. And ideally, you want investments with the lowest risks that also offer a high level of return. But what you'll find is when you find investments that have more potential for return, more potential for profit, often those are the investments that are also the most risky, that are the most likely to go bad and have you lose money rather than gain money. And third and finally, one important detail with investments that isn't thought about as much is liquidity. Liquidity. What about liquid? Are we talking about water, H2O bottles? No, I'm talking about something else. When I use the term liquidity, actually, you know what? I'm not going to say it. I'm going to see if someone knows it in the chat. I'll give you guys a minute. When you hear the word liquid, what does that mean? I'm assuming this is a smart group. I had someone bringing up, what was it? Stephanie bring up IRAs in here. It's a good sign. We've got some brains here. When you hear the word liquidity, what does that mean? I'll give you a minute to see if anyone knows. What did you say over there? Jacob, amount? I'm not sure if that was from before. Not quite, if that's what you're going for. Liquid is when the cash is readily accessible or liquid. And what we have over here, anything turning into money. Yes, both of those are absolutely excellent definitions of the term liquidity. The idea of when you put money into something, sometimes you want to get that money back. Maybe, okay, I know I put this money in this investment and I know maybe this business that they needed it for a year, but I actually need it after a month. Like I need to pay some bills, or I'm actually got a big medical bill and I got to take care of that, right? So with a lot of investments, you want to have the ability to access that money and get that money back as early as you can, if you wanted to. Some investments allow you to do that. They allow you basically get your money back whenever you want. But there are some investments that if you give an entity that money, they are going to be keeping that money until they're done with the investment. So ideally, you want high liquidity so you can get that money back, but you don't always get that. When I go through every single type of investment today, and I think there's 5 or 6 I'm going to go through, I'm going to be going through each one of these details, because every single one of these pieces of investment will have either high risk, low return, low liquidity. Generally, you will not have all 3 of these. You want all 3 of these, but every single investment is going to have a balance of these. You might have one of these be good or 2 of these be good, but you're not going to get all 3. So let's jump straight into it. Into the first and the most basic type of investment, which yes, this is an investment, even though people often don't consider it an investment, a savings account. Yes, that is correct. A savings account at a bank does count as an investment because the way that banks generally manage their profit levels, the way they get money, is that they have customers that take money, put it into their accounts, and those banks will take that money and they will almost invest it themselves. They might give it out as loans to businesses, or they might give it out as loans to people that want to buy a home. And usually they'll get a little bit money off their investments. And because you gave money to the bank, they'll give you a tiny little piece of that money. The reason why I start with this investment is because it is one that is so incredibly common that most people don't even think it is an investment. On top of that, it is probably the safest possible investment that you can put your money into. As you see there on the bottom, I have very low listed as risk. The reason why that is the case is because ever since the Great Depression in America in the 1930s, there has been a government program. Right over there, I got the logo for it, called the FDIC, or the Federal Deposit Insurance Corporation. Basically, what this program is that it is insurance on every single major bank in America that if, hypothetically, that bank were to shut down or use their money poorly or run out of cash and have to go out of business, declare bankruptcy, the customers don't end up losing all their money. The reason why this was established after the Great Depression is because during the Great Depression, there were so many banks that ended up closing. And for the most part, if you were a customer that had your money in that bank, you just lost it all. It was gone. If you had your life savings in that bank and you were about to retire, it sucks. I'm sorry, you're out. All the money is gone. Luckily for us today is up to an amount currently of $250,000. If you have $200,000 in that account or up to $250,000 in that account and the bank goes bust, it's like led by a horrible, terrible bank manager. It takes that money and invests in a bunch of bad stuff. Luckily, the government will back you up and they will give you that money back, which makes it basically the least risky investment out there. But of course, there is a counter to this. Because this is such a risk-free investment, this is probably the lowest return investment of every single one I'm going to mention today. I have some average percentages up there, which I'm going to keep. And these aren't hard and fast numbers, but they're relatively close to what you can expect. If I take $10 and I put it, let's just make it easier. If I take $100 and I put it into a savings account, I will be lucky if I get somewhere in the range of 0.05% or 0.5% increase on that money. So if I have a 0.5% increase, 0.5% return on $100, which is on the higher end for savings accounts, my $100 at the end of the year will be, what is that? $100.50, right? Woo, exciting, right? Yeah, no, that's not what we're here for, am I right, guys? Even though it's a safe investment and you get a little bit of return for it, it's not considered that great. The other benefit, of course, is liquidity. If you put money in a savings account, you can take that money out basically whenever you want. It's very easy. You can access your money like often within 24 hours without any problem whatsoever. So because you have those two, you don't get a return. So let's say we want something with a little more of a return. What do you got for us, Mr. Mempy? I'll tell you, voice in my head. Let's keep going. The next thing we have is something called a certified deposit. Certified deposits are special forms of savings accounts that you also get in banks. The big difference with a certified deposit is usually they have better returns. Usually an average of, at least in 2022, 0.1% to 2%. And just like savings accounts, because they are operated through banks, they are FDIC insured. So once again, if the bank closes, you get your money back. So once again, it's very safe. So why is it that the return is a little bit better? That's because there's a contract that you basically do with a bank when you get a certified deposit. That contract is that you will not touch that money for a certain amount of time. So if you sign a certified deposit or if you open a certified deposit account, you will say with that bank, hey, listen, I will not take this money out. I will not touch it for 6 months or 1 year or 5 years. Usually the range of a certified deposit is 3 months to 5 years. And almost every single major bank has certified deposits. And the bank says, okay, if you're promising to not touch this money, so we know we can do stuff with this money, we'll give you a slightly better interest rate. And for some people, that's worth it. Like, okay, yeah, I'm not planning to touch this money and it's just sitting here in the savings account, barely making any money whatsoever. So why does it make just a little bit more money? So the big thing you give up here is, of course, liquidity, but you gain a little bit more return. All right, let's keep going. Let's get out of banks now. And let's start talking about bonds. Bonds are one of those terms that I wouldn't be surprised if some of the people in this chat are familiar with. Hopefully you had an economics teacher that was good enough to tell you what this is. If they did not, I'm sorry. I may have forgotten to tell my students about this year, so I shouldn't be talking. But continuing. A bond is something that's a little bit special. What a bond is, effectively, is you are agreeing to give a loan to a particular entity. The first type of bond I'm talking about is a bond called a government bond. Sometimes in America, they're called a treasury bond. They're named after America's treasury or the US Treasury. Now, basically what I mean by you giving money or investing is you are effectively giving a amount of money to, in this case, the US government. The reason why the US government does this is because they'll often take that money and use it to pay for things that they don't necessarily have enough money with just off tax dollars. And it could be anything from military, healthcare, roads, whatever it may be. And because you are effectively investing in the US government basically makes this agreement with you with this bond where they say, all right, you've given us this money. We will be sure to pay you back your money in X number of years with interest. And usually when you sign up for a bond, it will say right on the contract, you will get this money back in 5 years with a 2% interest or 3% interest, whatever it may be. Usually the return on this is a little bit better even than a certified deposit. Unfortunately, it is once again a little less liquid. Now it depends on the bond you get, but the most common bond in America that is the most famous is a 10-year bond. So it's a very long time. You're sitting around waiting for that government bond, that treasury bond the keyword is mature. You wait that 10 years, the government pays you back your money with the interest on top. The one thing that is kind of nice about bonds that makes them different from something like a certified deposit is hypothetically, bonds can be sold. You are allowed to sell bonds before that maybe 10 years has gone up. So why would you want to do that? Once again, maybe you want to get your money back a little bit early. You won't get the full amount. Let's say hypothetically, I have a bond that says, okay, this bond says in 10 years, I put in $100 and I'm gonna get $105 back from the US government. Okay, I'm gonna wait. Let's say 5 years passes. There might be someone on the market that says, hey, listen, you can wait that 5 years, get your $105, or I will buy this bond from you for $102. So you still made a slight profit, but you don't gotta wait that extra 5 years. That's something that you are allowed to do with bonds. So in some ways, they are a tiny bit more liquid in that respect, but it is sometimes difficult to sell them. That is bonds, at least that is government bonds. I also put down here that the risk is still very, very low, is because the only way you wouldn't get paid back with a government bond would be if the government, well, the US government effectively collapsed, had no money left, and was unable to pay you back. And guys, if that happens, we got much bigger problems than whether or not your government bond gets paid back. It's one of the reasons why the risk there is very low. Generally, governments, at least the US government, is more stable than businesses, and the odds of it, can collapse, but hopefully it won't, at least in our lifetimes. As for another type of bond you can do, there's also a type of bond called a corporate bond. Now, a corporate bond is effectively the exact same thing as a government bond, except you are not investing in the US government, you are investing in a private business, a private entity. But it's effectively the exact same thing. You are signing a contract saying, hey, I'm going to give you this money, and they're going to invest it in whatever they want to invest in it. Usually it's for expansion purposes. Maybe a business wants to hire more workers or open another location or buy a bunch of new equipment or assets in order to help the business function a little more, right? They need money for that. So they'll often go to the public and say, we're going to be selling these bonds, give us money, and we'll hang on to that money, use it to make our business better, and we'll give you a return in, once again, X number of years. Once again, it's effectively the same as a government bond. There's two big differences. One big difference is that the rate of return is often higher on a corporate bond. Usually these businesses, once again, they're all about making money. That's their primary purpose. And usually the agreement they have is, listen, because we know, like, you want to give us money, we're going to make money, we can give you a higher interest rate than if you just do this through the US government. However, the downside is even if you do this with a larger business, businesses are rarely as stable in government as governments. There have been many stories, even in my lifetime, of very large businesses that people assumed would never break up, would never fail, would never go bankrupt. And it's happened. And if you don't believe me, just Google Blockbuster if you don't know what that is. There are many, many, many examples of this happening. And even though it's like a little more rare, especially if you get a bond with a larger business, like if you're getting with a large business like Amazon, for example, like you're probably fine. Amazon's probably not going out of business the next 5 years, but it is a little bit riskier, so you get a slightly better return. So that's bonds. Next, and now we get to the one that everyone thinks of when they talk about investing. And I didn't want to do this one to get started, all right? And the very basic reason why I didn't want to get started with this one is because I often caution young investors to be very, very careful when they get involved in this type of investment. And the reason why I caution young investors to get involved with this type of investment and think about others is because of what you see in the bottom left over there, risk. First, what is a stock? A stock, very simply, is a piece of a company. When a company is created, it's usually created by an owner, and it's privately owned by that owner or maybe multiple owners, totally fine. Eventually, when a company gets big enough, they might want to expand even further. If you can think of the largest companies that you're familiar with, these are the ones I'm talking about. Your Apples, your Amazon, your Googles, companies like that. And when a company gets to decide, they can decide to list themselves on the stock market, also known as going public. Stop themselves from being just privately held by one or two owners and being publicly held by potentially thousands of owners. And then what they do is they begin to sell tiny little pieces of their company. We're talking thousands, tens of thousands, hundreds of thousands, and each one of these little pieces is called a stock. There are so many of these pieces that are constantly traded on a daily basis, as long as it's a weekday and the stock market is open, that you as a regular person, me as a regular person, can potentially buy one of these pieces or stocks and become an owner of that company, at least a part owner. I mean, you're a very small owner. You only own 0.0000001% of that company. You own more of that company if you own more pieces or more stock in that company. So for the most part, hypothetically, you don't have a big say on what that company does. Now, people who own a large amount of stock in a company can eventually have a huge say in what that company does. This is for the billionaires, though. This isn't for us, right? And they could potentially have a seat on that company's board, or they can vote in major business decisions for that company. But from our perspective, why does it matter that we get to be a part owner of that company? The reason why it matters is because we get to share in the most important thing that company does. We get to share in the profits or the losses of that company. That right there is what it means to be an owner of a company, first and foremost. So when you are purchasing stock, the big thing you are looking for, and this is the thing you're probably very familiar with, this is the most famous type of investment, is you're trying to predict what types of companies do you think are going to do well in the future, maybe in the short term, in the next couple of days, the next couple of months, or maybe in the long term. Maybe you think this company is going to do well over the next year, over the next 2 years. Every single stock has a price. And when you purchase the stock at that price, once again, you can purchase multiple shares, you are hoping that that company will increase in value, that company will do well. And when a company increases in value, generally the price of that stock will also increase in value. And sometimes stocks do this thing called a dividend, where companies will give you pieces of how much that company made in terms of profit. Or sometimes what you can do is you can take that stock and say, all right, I predicted this company was going to do well, and I bought a share of this company at $50. And the company did great. In the next year, it doubled. It's up to $100. Great. So I'm now going to sell it. on the stock market, and I am going to make a $50 profit just like that. However, obviously, I must caution you, because of all the investments here I've discussed thus far, this one, by and large, is the riskiest, because you never know with 100% certainty what a company is going to do in terms of its profits in the next 6 months or the next year or the next 5 years. If people were able to predict it perfectly, then everyone would be making money off this, and not everyone is making money off this. So the big downside is that you could predict, hey, I think this company is going to do well, and I'm going to invest $50 into one share, and maybe that company tanks and doesn't do well, and the value of that share goes down to $10. If I try and sell it now, I just lost $40 just like that. And that is why buying individual stocks, individual companies, though it may be easy, right? There are many apps that you can do it with now. It's all digital. It's easier than ever than doing it, right? You have to be cautious when you invest in this, because more than all the investments here, it is the one that potentially has the highest chance of return, but also has the highest possible risk. It is very liquid as well as the other benefit. Usually with stocks, especially famous stocks, it's really easy to list it on a stock market using either a stock broker or an app of some kind, and it'll usually be purchased relatively quickly because there's so many shares and people that want to buy it. So I have one last one left, all right? And for those, before people start saying in the chat, for example, like, Mr. Menefee, what about this? What about this? I only have a half an hour, so I don't want to hit every single one of them. So I'm going to go to this last one, and then we're going to do one tiny activity and we'll finish up in case I'm losing anyone. The last one I would like to talk about is a mutual fund. Now, this one has many types of names, and it also is connected to other types of investments. You may have heard the phrase index fund or ETF, which is kind of connected to mutual funds, but to make everyone's life easier, I'm just going to use the term mutual fund. A mutual fund is a very interesting type of investment. If you look at it, the first word you see is mutual. Something that is mutual means together in a group, obviously, right? And that's what defines this investment that makes it special. What makes a mutual fund interesting is that you are not joining this investment by yourself. You are joining this fund with a large pool of investors. Sometimes it can be, wealthy billionaires and like a couple of, these fat cats that are just together, maybe 10 or 20 of their buddies that are pulling their money together. Or sometimes, at least for you and me, regular folk, it can be just thousands and thousands and thousands of regular people that decide to pool their money into this fund. Now, why would you want to do this? Why would you want to pool your money with a bunch of other people into this fund than just purchasing potentially stocks yourselves or bonds yourself? Because a mutual fund can have bonds or stocks and many other types of investments. The reason why is because when you pool your money, that fund is able to purchase a diversity of investments. It's able to buy stocks in hundreds of companies. It's able to buy bonds with dozens of companies or dozens of countries even, right? It's able to get hundreds and hundreds and hundreds of types of investments. And the reason why this is valuable is for one very simple reason. Generally, economies grow, especially in the United States. We live in a country where even though the United States economy has bad years or bad 2 years, I mean, we don't have to look too farther than the last 2 years of COVID in order to find that, right? Generally, if you look over the last 10 or 15 years, the American economy is always slowly growing. It always bounces back. It may take a long amount of time, but generally, the economy is always bouncing back. The idea of a mutual fund often is rather than just investing in one company and hoping that that company does well, you invest in tons of companies. So in the worst case scenario, if 1 or 2 or 5 of those companies goes bankrupt, that doesn't hurt you very much. It only takes away a tiny percentage of your profits. And generally over time, because you are investing in so many different types of companies' investments, your mutual fund will see an increase in value almost every single time. Now, that said, there are different types of mutual funds. You see over there, I wrote low risk versus high risk. There are some mutual funds that are designed to be low risk, kind of like I'm describing, where they're designed to be, hey, like we're just doing kind of basic investments, nothing crazy, really diverse investments. So you're not going to make a ton of money, but you'll make more than if you put in your savings account, and it'll always increase over time, even if we have a bad year. Some mutual funds are a little bit riskier. They try to invest in, just a couple of key companies or a lot in those key companies or certain bonds. And, it might fail. Those mutual funds might lose more money in the short term, but they might gain more in the short term as well. Also, something to think of with mutual funds is there are different types of mutual funds in terms of how they are managed. There are some mutual funds where they are kind of automatic, right? You kind of look at them and they say, these are the things we're investing in and we're not really changing. And that's just basically it. It's kind of done by a computer program. It's done automatically. Okay. But there are other mutual funds where a person is managing the fund and the person says, hey, I'm a financial specialist. I'm managing this fund. I'm going to move money around, maybe take away stock from this company, invest in this company, take away bonds over here, move this money over here. And because I'm an expert, I can maybe make a little bit more value on my fund. And sometimes they're right and sometimes they're wrong. And usually those mutual funds have like tiny bits of fees associated with them that is taken out of the money you've invested. And some people say that's not worth it because you can just throw it in something automatic with less fees. Some people say it's worth it because someone with economic experience and financial experience could potentially make you a lot more money than if you just throw it in something that's kind of automatic. But that's kind of the nice thing about mutual funds. They are many, many options out there in terms of what you want to do in terms of risk, in terms of how it's managed, and also kind of like stocks, they are relatively liquid. The vast majority of mutual funds, you can get your money in and you can get your money out relatively quickly. All right, so that's done with me talking about the different types of investments. And I have about 5 more minutes to my time. And this is what I want to do before we give you guys time to ask questions and before we hear from some of our lovely co-presenters here that are talking us out. What I want to do is I want to do a short activity. And if you're in front of your keyboards, jump back into them because I'm going to need you to type stuff in here because we're going to play a little game. We'll do this for a little bit. The name of this game is called Spot the Lie. Spot the Lie. So how does this game work? What I'm going to do is I'm going to present a series of statements on investing. Every single one of these statements is going to contain a single error within it, basically a lie. Everything in the statement will be correct, but there'll be one thing there that's wrong, and everything you'll need to know is based on what you just learned over the last 25 minutes. What I'm going to ask is that we are going to have you look at these statements, and you're going to have to try to identify the mistake, and you're going to have to type in the chat, this is the mistake, Mr. Menfi. And what I'll say is the first 3 people to correctly identify the error or the mistake will get a point. We'll play this for a little while and I'll announce a little point, or I'll announce a winner at the end. What I'm going to say specifically is that the statements are color coded. There's 4 colors for all the statements. So you don't have to necessarily identify the mistake. All you have to do identify is the color of the text that contains the mistake. So one sentence will be red, one will be green, one will be blue, and one will be yellow. You'll just have to type in blue. That's what the mistake is, right? And as I said, first 3 people that get this will get a point. Now, one thing I want to test, because I wasn't sure if this is going to work, can you guys do me a favor? And I'm asking people that are viewing right now, can you check if you are able to private chat with me? I'm not sure if you're able to. If not, it should work out fine, but see if you're able to private chat with me. So Jacob, Margot, oh yeah, Margot just private chatting me, good. So private chat should work. So let's jump straight into this. Try to go for private chatting specifically. Thank you, Estella, but yeah, we're looking for private chat specifically if you can, private chat. So if you click my name in the chat function, it should say private chat to Mr. Menfi and it should see how to work. So if you go to the chat, click the little blue bar and click on my name and try to do that in order to private chat. If we can make that work, great. If not, don't worry about it. But let's jump straight into this now. Okay, so here's the first one. Remember, first 3 people to get it correct, get a point. No second guesses. So what your first is, guess in, it's over. Here we go. Getting a savings account is probably the least risky investment there is. Interest rates are unfortunately very low compared to other investments, but many people like being able to have access to their money whenever they want. Many customers also love the reinsurance that if a bank ever fails, that the government insures their savings up to $100,000. Where's the lie? All you have to do is say a color. First 3 people that correct get points. I believe we already have our first 3 people that got it. So I believe Jacob, Sheila, and Margot got it incorrect. By the way, that is blue, but Jacob, don't worry. I will count it as purple because I'm not surprised if it shows it as purple on your screen. Blue on my screen. So 1 point for Sheila, Jacob, and Margot. If you didn't get it in time, let's go on to the next one. And you are allowed to put it in even before I'm done speaking. Let's go. Liquidity is incredibly important when choosing an investment. You don't want too much of your money tied up and not be able to access it. Certified deposits often have better returns than savings accounts, but your money is locked sometime for years. The same is true of bonds and mutual funds. The returns may be better, but if you take out the money too soon, you get hit with penalties and fees. I believe I have 3 people that got it in there already. So let's take a look. Oops. So the first 2 people that got that one was Emily, Jacob again, and Dara. I apologize if I mispronounced that name, by the way. Yes, by the way, the mistake there, if we're taking a look, is that mutual funds, you do not get hit with fees. Mutual funds are more liquid, as I said there. You can get out of them whenever you want. Bonds, you're often locked in there. And I forgot to say the answer for the first one. The answer for the first one, my apologies, is that the government insures your savings up to $250,000, not $100,000. All right, let's keep it up. On to the next one, number 3. The purpose of a company issuing corporate bonds is to generate money for growth and expansion. As a holder of a corporate bond, you own a small piece of the corporation in question. Usually your money is locked for a set period of time, at the end of which the company pays you a return on your investment. Corporate bonds are often considered a bigger risk than government bonds because a company is more likely to default on paying back the investment than a government. All right, a lot of people guesses. Let's see who got it first. Okay, so the correct answer for this was green. So that is another point for Margot, another point for Jacob, and I believe Stephanie got a point there. So we're looking at green. As a holder of a corporate bond, you own a small piece of that corporation in question. That is not true. You own a small piece of a corporation when you own a stock. When you buy a bond, you're just giving some money to that corporation. They're going to give you money later. You're doing business with a corporation. You're not technically a part owner unless you own a stock. So let's keep going. We have time for a couple more of these. Mutual funds are usually a safer investment than only purchasing individual stocks. Since you are investing in a variety of companies, bonds, etc., if one were to fail, then your other investments would balance out the loss. In addition, most mutual funds are insured by the government in case they fail. That said, there are mutual funds that are designed to be riskier and safer. So the risk level of a mutual fund also depends on which fund you choose. I got some 2 guesses in. I believe we have our 3. So Margot got herself a point. Sheila got another point. And then who's the last person that said yellow? I believe Grace did. So the reason why it is yellow, guys, is that mutual funds are not insured by the government. If a mutual fund collapses, it sucks to be you. All your money is gone. The only things that are insured by the government are usually things related to certified deposits and savings accounts. All right, next one. The length of time your money is locked in bonds or certified deposits is variable. Often they range from a few months to many years. Certified deposits usually have a longer possible maturity date when compared to bonds. One additional benefit of bonds is that they can usually be sold before they mature in order to unlock your money. But this is usually not true of certified deposits. Okay, I got some guesses in there. And it looks like that is correct for those first 3 right over there. So that is a point for Jacob, a point for Stephanie, and a point for Margot. So if we're taking a look at this, guys, yellow was the part that was incorrect. The reason why is, and this is a hard one because I only mentioned it briefly, certified deposits actually usually have a shorter maturity date than bonds. Usually the longest certified deposit will be 5, maybe 10 years, but it's very rare. Whereas you can have bonds that can be, especially government bonds, 30 years. So bonds usually are much longer, much more likely to be locked in. Okay, I have time for a couple more. Let's do a couple more. Next. The 3 most important factors to desire with investment is low risk, high return, and high liquidity. And there is no investment that has all three. Individual stocks have very high possibility for returns, but also very high risk. Mutual funds are less risky, but have much less opportunity for higher returns. Bonds are even less risky and very liquid, but the returns are usually even lower. At the end of the day, you need to choose what investment works for you. Well, there's one person got it right. There's two person got it right, and that's 3. Margot, Jacob, and Emily. Blue is the incorrect answer. I mean, correct. You know what I mean. Sorry, corny joke. So the thing that was wrong in there for taking a look is the idea that bonds are very liquid. That is not true. Bonds, if you remember, are locked in sometimes for years. You could sell them, but you need to find a buyer, right? So they're actually a little more on the moderate to low side in terms of liquidity. Okay, I am going to do one last one, and then I'll turn it over to my co-presenters. This last one's going to be a special one. I'm actually going to skip the last one I prepared. All right, you ready, guys? You ready? Here we go. I used this picture in the presentation twice. I also used this one once. I didn't use that one at all. I didn't use that one either. One person got it right so far. Only 2 people got it right, and there we go. Megan sneaking in there with the guess, getting your point. The correct answer is yellow. I did, in fact, use that yellow one once. I did not use, it's true, I didn't use the monkey one. I did use that first image twice, and I used that second image once. So taking a look here, just a little bit of points, and I'll turn it over to my co-presenters. It looks like we have a tie for first place. I would like to congratulate Jacob and Margot with 6 points each. Congratulations for paying attention to my droning voice. I truly appreciate it. I hope you guys did as well. So that is me. I will turn it over to you guys for Q&A and such. So at this time, if anyone has any questions, you are free to type it in the chat. Abby, Grace, Margot, Emily, was there anything else you need to say at this time?
I'm not seeing any questions coming through the chat, but Margot, if you want to take it from here, you can just talk a little bit about your experience or ask Mr. Menfee any questions you have, since we have a few more minutes left of our presentation today. So might as well take advantage of his time and his expertise.
Expertise, making me feel good about myself. Sorry, go ahead, Margot.
Yeah, no, you're good. I just had one question. What type of investment do you recommend for high schoolers? Like, you learned about all of those, then if we want to do something now, what do you think is our best option?
That's a great question. So generally, my recommendation is that you should definitely have a savings account. There is basically no downside to a savings account. I recommend every high schooler to open one. It's a nice, easy practice. I also recommend small certified deposits, not necessarily with all your money, because as a high school student, you're probably spending some of that on the things you need, but having a small certified deposit with the bank is a nice little way to make a little bit of money, and it's a good way to practice the responsibility of, okay, I'm going to set this money aside and not touch it. I'm not going to touch it for 6 months or 1 year. I can be responsible and I cannot do that, right? I generally don't recommend dealing with stocks until you get older. I have some high school students that even when we go to college, they'll mess around a little bit with it. I generally don't recommend it. In my opinion, and this is true for even people that are not in high school, stocks are effectively legalized gambling. And like many gambling games, you can get good at it. Like there are people that get very good at poker. You can get very good at stocks. And when you're young, when you're the least economically knowledgeable, I generally say that that's not the best idea to be messing around when you don't have a lot of financial resources. You could try messing around with a bond, maybe even a mutual fund, but in all honesty, when you're in high school, savings accounts and certified deposits, I wouldn't go crazier than that. If you really did want to go crazier than that, I would say the one thing to avoid is definitely don't touch individual stocks until you get older.
I have one more question. So like, then when it comes to individual stocks, what do you think is the best or what financial situation do you think someone should be in before they start, or when they want to start investing in?
Great question. Great question. And I see Dara also had a question there as well. I'll answer that one in a second. All right. Once again, I apologize if I'm saying that wrong. But to answer Margot's question first, right? My general recommendation is that you want to have as low debt as possible, or possibly even no debt before you start getting into longer term investments. Now, it does depend on the debt, right? So if you are someone that, for example, goes to college and need to take out a student loan, if you had to take out a student loan, let's say a private loan with the bank, usually those student loans have very high interest rates, often, 5, 6, 7, 8, 9%, right? So I would generally say, like, listen, you could invest in stocks if you have a little bit of money to your side, but are you going to be making more money than you're losing than just by paying off that student loan debt is the idea. Some people get good loans, however. There are some people that get student loan debts that are relatively low interest rates, maybe a government student loan, for example, or a loan through a school. That's like a good student loan. If you're in that scenario and it's a low interest rate, like a couple percentage points, then I can say, okay, maybe you can start messing around with some of those bigger investments. But the big thing I would say is that you do not want to have a large amount of debt. Most commonly at your age, it would be student loan debt. But even if you have a large amount of debt with maybe a car loan, for example, or even credit card debt, you don't want to have a lot of high interest debt in your pocket before you start messing around with that. I guess the second thing that I would say before is that you don't want to get invested in riskier types of investments until you have a little money put aside as like a just-in-case fund. A little money put aside in a just-in-case fund, like that's the stuff that you can put into savings accounts or whatever, or maybe even a certified deposit, right? As an emergency fund. As long as you have a little bit of money like that, then in my mind, all right, you want to start messing with risky investments, that's fine, go and do that. But as long as you have your mind have a little bit of money as an emergency fund, so if in your mind, like in the worst were to happen, you were to lose all of that investment money, you would be okay, then I would say that's okay. Make sense? And I said, Dara's a great question. What is best for international students in the United States? That's a phenomenal question that I will be honest is a little bit out of my expertise. So to my understanding, most of the investments I talked about today, you basically do like it's no extra steps or no significant extra steps if you are an international student versus being a domestic student or being an American citizen. Like you can open a savings account without too much problem, to my understanding. Same thing with a certified deposit. You might have to go with a little bit of paperwork for some of those other investments, I would say. And also there's the possibility of investing not necessarily investments in the United States. Obviously you can do it at your home country. That's totally fine, right? But a lot of that depends on your personal situation would be my answer. A lot of it depends, like, are you a student that hypothetically is planning, all right, I'm an international student and I am living here like for the next 10, 20 years, right? Or I'm an international student and maybe I am going back home in 5 years, right? Because the answer to that question would answer this idea of, okay, maybe I don't want to mess around with too much investments here in the United States, or maybe I do, I would say. Not the best answer to your question, I know, because a little bit outside my expertise, but I will say I will echo the advice I said for any young person, like pretty much no matter what country you're in, this is true for any young person, just this idea of I would not mess with stocks in any country until you're out of your primary education. That is something that I would not recommend no matter where you are or wherever you're growing up. That is something that I recommend once you get a little bit older and a little more financial experience. Thank you. That was an excellent question. I always say things are excellent questions when I don't know the full answer to them. I will take another sip of my water to buy time if there's any more questions. That is a very loud straw. Oh, okay, this is a great question. I'll answer this one and then Samantha, I know you can come in and close us out. So Dara, Phenomenal question that you just asked right there, and something I skipped today that I had in the slide and I got rid of. So I'll answer that one and then we can finish up. The question was, what's a checking account and how is it different from a savings account? Phenomenal question. Generally, a savings account is for investment purposes. It's for putting money in a bank and hoping that money increases. A checkings account is not for investment purposes, it's for the purposes of transactions. If you have a debit card, for example, or if you want to use an ATM, for example, or maybe you have a cash app service like Apple Pay or Venmo, all of those services are tied usually to a checkings account, because in the olden days, we would use physical paper checks, right? That is the purpose of a checking account. It is a way for you to easily access your money for transactions and pay businesses, your friends, whatever it may be. Because that is the service you are getting from banks, the service you're getting is an easy way to move money around for your day-to-day life. Usually, most checking accounts either have no interest rates whatsoever and a very, very low or a very, very low interest rate. There are some checkings accounts that have rules like you have to have at least $1,000 in the bank in order to access the checking account, or they'll have a rule that like we're going to charge you $1 a year or $5 a year in terms of fee in order to use the checking account. But regardless of whatever the requirements for a checking account is, that is the primary goal for a checking account. It's not to make money. The interest rates are usually not at all or very low. It's to be able to easily make transactions, to pay for the things that you need. So it doesn't fit in this investment presentation, but checkings accounts are something that I would also recommend generally young people getting relatively early, because it's a way for you to have your own money in a place that you can easily access rather than just dealing with cash all the time necessarily. And I think that'll probably be our last question. You're welcome. Samantha, you want to finish this up?
Yes, that'd be great. Thank you so much, Mr. Menfi. We really appreciated the presentation. I learned a lot. That was wonderful. Margot, do you have any other, anything you want to share about your experience with IIG before I close us out today?
Yeah, sure. So again, I'm Margot. I'm a junior at Brookline High School, and I want to say that I actually joined the Women in Entrepreneurship Club back in the fall because I wanted to learn, not only more about investing, but just understanding financial literacy. And I also wanted to hear from really cool people about their jobs and working in the financial field, which has probably been my favorite part. But I guess I'd say one thing that I've realized from being in the club is that, like, even if you have no interest in going into finance, which was something that's kind of where I was at one point, like just learning how to invest and just taking care of your money is something that anybody can do, and how extremely valuable it can be later in life. So that's kind of why I joined the club and why I really like being a part of it.
Great. Thank you so much. We really appreciate hearing from you, Margot and Emily and Grace. And thank you to all of the students who tuned in today. We will be uploading this presentation today to YouTube, and it's also on Facebook. So feel free to share that with your friends and family so they can learn a little bit from Mr. Menfi as well, even though they won't be able to participate in the fun game that we were able to do today. I also wanted to share, and I'll put this in the chat, we do have some really great resources on basic banking on our My Financial Life website. So I'll put that into the chat after, or I'm sure one of my colleagues is probably already on it. But there's some really good information about the differences between the checking accounts and savings accounts. That could be a really great resource as you're starting to get those first paychecks and decide what the difference is and what makes the most sense for you. So please be sure to check out our My Financial Life website for all sorts of resources on different financial topics and the different experiences that you'll have throughout your life. So without further ado, I just want to say a huge thank you to all of our participants today and our presenters. Thank you, Mr. Menfi. Thank you, Grace, Emily, and Margot. Thank you to Abby and Ruben over at the Council on Economic Education for all of your support in getting today's presentation today. And thank you to the Massachusetts Board of Library Commissioners and libraries across the state for being such a great resource to all residents of Massachusetts when they're grappling with, these really big topics. We heard that teens are really, really interested in investing, and so we're glad to be able to offer this today. I will close out the presentation, but at the end, a survey will pop up, and we hope that you'll fill that out so that we can keep improving our programs and offering programs that mean a lot to you. So thank you again, and have a great rest of your day.